at the bull and bear case for Dollarama, the largest operator of dollar stores in Canada. Dollarama expects to open its 1,000th store this year, and profit keeps climbing, with 3/4 of their sales now coming from items over $1. So should you own it? We'll take a look at both sides of the argument and let you make up your mind. Anita Brunsma, equity analyst, TD Asset Management, will give us her 3 top points for the bulls and the bears. Here we go. So number 1 is growth opportunities.
So Dollarama is a growth story. It's done a great job of growing its sales and its earnings. And over the last 5 years, it's grown its earnings per share at about 20% per year. So this is very good. So there's been 2 growth drivers that I think will continue. The first is that Dollarama has been opening a lot of new stores. And despite what you might think, that the Canadian market is saturated and there's a Dollarama on every corner, Dollarama thinks it can open another 400 stores on top of the 1,000 it already has. So this represents growth of at least another 5 years. Then on top of that, we have the fact that Dollarama has done a really good job at growing its sales per store, or its same-store sales growth. And it's done this by offering really good products. So it's very skilled at sourcing products that are perceived to be very good value by customers. And the other thing, and you mentioned it in the introduction, was the fact that it's been offering more products at higher price points. So whereas they used to offer products just under $1, now they offer $2 and $3, and they anticipate that they'll be offering products at even higher price points in the future. So that'll continue to drive their sales growth.
And number 2 is strong execution.
So I think there are 2 things that Dollarama has done particularly well. One is on their brand. So the top thinkers at Dollarama had this vision of what a dollar store should be. It should be clean and easy to shop, but still have that sort of treasure hunt mentality. And I think Dollarama's done just a great job at building that brand, and I think now it has a brand advantage. And the second is on their margins. So the management team at Dollarama has been laser focused on maintaining their profit margins. And it does this in a couple of ways. One is that when their buyers go out to find products, say in China or in other places, they go out with a particular profit margin in mind, and they kind of work backwards from there to find the right products. So that means they're very disciplined on the profitability. The other thing Dollarama has done really well is it's been able to make really small operational improvements to its business. So for example, a few years ago, it installed barcode scanners in its store, a very basic, retail thing, but it really helped to improve their labor cost. And there are a lot of these other small things that Dollarama can still do to improve their margins.
And number 3 is good free cash flow.
So one of the things we like best about a company is free cash flow generation, and Dollarama has it in spades. So what has Dollarama done with their cash flow? Well, initially they paid down their debt. They've been spending money on building all these stores. And more recently, Dollarama has been buying back its own shares and also increasing the dividend. And these are things that are all good for shareholders.
So number 1 is competition concerns.
So Dollarama's main competitors obviously are the other dollar stores. This is the independent kind of mom and pop shops, but also some of the smaller chains in Canada. So there is the risk that these chains could sort of step up their game and become better competitors to Dollarama. But I think the bigger concern is Walmart. So as Dollarama starts to introduce these higher price points, they're no longer a true dollar store. So now they're going more head-to-head with Walmart, who, as we all know, is a formidable competitor.
And number 2 is future headwinds.
So I think people could point to 2 concerns with Dollarama's headwinds. So one is on that same-store sales growth that I talked about. So they've been growing their same-store sales between 7 and 8.5%. That's a phenomenal number for a Canadian retailer. So that's really been driven largely by the fact that when people go into the store, they've been spending more per visit. We call that the basket. And it's been less driven by them getting more customers in the door. So really the question is, is there a ceiling on how much someone's willing to spend at Dollarama in one visit? And then the second one is on their margins. So as I said, so far they've done a great job on their margins, but there are headwinds. One would be China. So Dollarama sources roughly half of their goods from China. And there's been wage inflation happening in China. So eventually, is it going to become more difficult for them to find products that meet their profit margin targets but still provide good value? The second is on the currency. So we've seen the Canadian dollar depreciate significantly against the US dollar over the past year to year and a half. So Dollarama sources a large portion of its goods in US dollars, including what it buys from China, so it's exposed to that Canadian US dollar trade. And so far it's done a very good job through hedging, but at some point you can't hedge that out anymore, and again, will it be hard for them to find profitable products that offer good value?
And number 3, high valuation.
So this would be the biggest concern people have about Dollarama, and for some investors actually it's probably the only concern. So if we look at the most commonly cited metric, it's the price to earnings ratio, or the PE ratio. So Dollarama right now trades at 27 times next year's earnings estimate. So these are the estimates that analysts put on the stock. So just for comparison, if we look at the Canadian market as a whole, looking at the composite index, forward earnings are about 14.5 times. And if you look at a basket of Canadian discretionary stocks, which is sort of their peer group, they trade at about 20 times. So Dollarama at 27 times is a very significant premium. And in fact, this is the highest valuation Dollarama has ever traded at.
So what's the word on the street? What have you been hearing?
There's definitely more bulls than bears on Dollarama on the street. You know, analysts and investors believe that management will continue to use their expertise to grow their sales and keep those margins strong and keep the cash flow going.
And what's your opinion?
Dollarama is a great company, and I see no reason why that will continue anytime in the near future. But at these levels, it's very hard to justify the valuation. Now, I'm okay with paying a premium valuation for a good company that keeps delivering, and that's what Dollarama has been doing over the past several years. But at these levels, it probably makes sense for investors to look for a better entry point.
All right, thank you very much, Anita. So there you have it, Anita Brunsma on the bulls and bears case for Dollarama. I'm Marianne Deveni. Thanks for watching.